Hello everyone, welcome back to Mindful Investing. It's time for our monthly full portfolio update. And since today is the last trading day of August 2025, let's review how things are looking. Today was a bit of a red day for me. I'm down about $3,300, but overall, year to date, I'm still up $36,000, which works out to an 18% gain. Right now, I'm holding about $92,000 in cash, which is earning around 4% in Robinhood and waiting for the right opportunities. Now, because of this cash position, it's a little tricky to see the exact amount invested versus current value numbers at a glance. So, I created a spreadsheet and here's the breakdown. I've invested about $118,000 and the current value of those positions is $144,000. That means I'm sitting on $26,000 in profit. And this doesn't even include the swing trades and options we have done this year in names like Microsoft, Arista Networks, McDonald's, and a few others. All right, before diving into my portfolio in detail, let's take a quick look at some macro data that's shaping the market right now. The fear and greed index is still sitting in the greed zone, which tells us sentiment is leaning bullish but also a little overheated. The VIX or the volatility index is at 15. That's still below its 50-day EMA, so nothing alarming there. It shows the market is fairly calm right now. But here's something I really want to highlight. Margin debt by retail investors is at an all-time high of $1 trillion. Now, if you are using margin in your account, please be very careful. Margin can be extremely dangerous, especially if you see a sudden drop in the market. Brokerages can force you to deposit more money or they'll start selling your shares to cover the margin. That forced selling is one of the main reasons market experience sharp drawdowns during major market events or shocking news. People on margin don't even get the choice. Their positions get sold automatically. So, just a friendly reminder, use margin responsibly or better avoid it if you don't fully understand the risks. Alright, now let's dive into my portfolio and go over what I added and sold this month. First up, I bought 12 shares of Intuitive Surgical, ticker symbol ISRG, at an average price of $478. That's currently a $5,700 position in my account, and I'm down about 1% right now. This is a swing trade for me. On the daily chart, ISRG is trading below all of its EMAs, and on the weekly chart, it's sitting under the 50-day EMA. My view is that it's going to form a cup or a U-shaped pattern and then move back up about $525. If that happens, I'm looking at a $40 move, which should give me around $500 in profit. It's also a high quality company with a great balance sheet, and even my model shows a decent returns in long term. I like their business, so I don't mind owning this for the long run if it pulls back more. My plan is to add more shares at $448 and then again at $390. Next, I opened another swing trade in Lululemon. I bought 20 shares at $206 and I'm currently down about 2% on this. Lululemon is reporting earnings next week, so my plan is simple. If the stock moves up to $220 or $225, I'll sell before earnings. If not, I'll hold through and see what happens after earnings. This is purely a technical play for me. I recently made a full video on Lululemon covering their business model, revenue streams, price targets, and technical setup. So check the link in the description if you want the full breakdown. Moving on, I also added to my Berkshire Hathaway position. I bought 5 more shares. So now I hold 10 shares in total and I'm up about 7% on this. This was one of my favorite setups. When a quality stock drops below its 200-day EMA, I start accumulating it. Then I wait for it to form a cup or a U-shaped pattern before taking profits. This pattern has worked really well for me over time, and I even suggested it to some of my friends who also bought the dip. My plan here is to exit around $530 and then I'll swing trade it again when another good setup comes along. Now, let's talk about Duolingo, ticker symbol DUOL. I currently have 16 shares at an average cost of $345 and I'm down about 14% on this. They had a really strong earnings recently. The stock jumped to $430, but since then it's been selling off pretty hard. Some people are worried that LLMs might take away Duolingo's market share, but honestly, I don't see that happening. I'll continue to accumulate here. Right now, it's trading below all the major EMAs on the daily chart. and below the 50-day EMA on the weekly chart. My next buy zones are $277 and $237. Fundamentally, the company is still in a strong position, and I've updated my model. Their expected EPS growth rate went up from 44% to 48.4%, which is great for us long term investors. For me, this is just an accumulation zone. Next up is FICO. I added another $500 into this position. I now hold 1.7 shares worth about $2,593, and I'm up about 3.7%. I was waiting for it to hit the 200-day EMA on the weekly chart, which was at $1,220, but instead it bounced back up from $1,300. I believe that was the bottom for FICO this year. As rate starts to go down, FICO should benefit from things like mortgage refinancing, which means the stock could push up towards $2,000. I might add more if we get another red day on FICO. And finally, let's talk about my ETFs, SCHD and IBIT. As you guys know, I started the 15-year challenge recently where I invest $50 into SCHD and $50 into IBIT every single week. I'll link that video in the description as well if you'd like to join me in this challenge. This month, I bought $150 worth of SCHD and I now hold 217 shares worth about $6,000 and I'm up 1.2%. In IBIT, I hold 27 shares at an average price of $55.95, which is up about 9.5%. On top of my recurring weekly buys, I also picked up 10 more shares today at $61.60. Since IBIT dropped below its 50-day EMA, I've also set my GTC buy order at $60. And if it falls below its 200-day EMA, I'll keep accumulating shares. So those are my recent purchases and swing trades for this month. Now let me show you my core holdings, which include my growth stocks, dividend stocks, and ETFs. Let's kick it off with one of my top performers, which is Broadcom. I currently hold 111 shares at an average cost of $180, and I'm currently up 64.5%, which is close to $13,000 in gains. Broadcom also pays dividend. I recently got $65 in dividends in June, and I'm also generating passive income by selling covered calls, which makes this even more valuable as a long-term hold. Next up is Vertiv Holdings, one of the most exciting plays in the AI infrastructure space. I own 101 shares at $84.50 and I'm up over 50% on this, which is more than $4,300 in gains. As hyperscalers and big tech double down on data centers, Vertiv, with its core strength in cooling and power solutions, stands to benefit massively. Moving along, we have Lam Research, a key player in semiconductor equipment. I currently have 109 shares at an average price of $74.75 and I'm up 33% on this. Now the stock did dip little post earnings, but long term I'm still bullish on Lam Research. Now let's talk about the king of AI, that's NVDA. I currently have 34 shares at an average cost of $123.25 and I'm up 41% on this. I'm confident NVIDIA will continue to dominate the AI and data center space, and I don't think AMD or Intel will take much share from them. So I'm holding tight. Speaking of AMD, I currently have 20 shares at an average price of $106, and the stock is now trading at $162. So I'm up 52% on this. All right, now let's shift gears to Amazon. I have 20 shares with an average cost of $192.76, and right now it's trading at $229. That's a modest 18% gain, but I'm in this for a long run. I'm watching the $200 level closely, which lines up with key EMA support, and I'll be adding more if we get there. Now to Google, I hold 35 shares at an average cost of $163.71 and I'm up 30% on this. It did pick up the momentum which we were all expecting, and I will hold this tight, and if we get a pullback near the 200-day EMA, I'll likely add more. Alright, now let's talk about a rare loser in my portfolio, and that's Chipotle. I now own 78 shares at $52.69 and I'm currently down by about 20% on this. This has been very tough, but here's why I'm holding. It's now below the 200-day EMA on the weekly chart, and that's only happened twice in the last 6 years. I'm considering averaging down here. I'll buy 22 shares at $40 to bring down my average. Finally, the trade desk. I currently have 32 shares at an average price of $65.47 and I'm down by 16%. Fundamentally, nothing has changed with this company. So I'm planning on buying more at $43, which seems to be a strong support. And if the momentum is up, I'll likely add more around here at $53. Now, let's switch gears a little. While high growth stocks are exciting, the steady and predictable nature of dividends plays an equally important role in my portfolio. And this year, I've been actively building my dividend stream, and the results are already starting to show. So far in 2025, I have collected a total of $1,475 in dividends, and in August alone, I received $171 in dividends. This income is still in its early stages, but as I continue to accumulate dividend paying stocks, I can already see the compounding effect kicking in. I expect this number to grow meaningfully by end of this year and even more in 2026. All right, now let's walk through my current dividend holdings starting with Realty Income, one of my favorite monthly income stocks. I have 51 shares at an average cost of $54.84 and I'm up about 7.9%. The dividend yield is 5.48%. It's a slow and steady kind of stock, exactly what you want for passive income. Next up is Coca Cola. I have 50 shares at an average cost of $63 and I'm up about 9% on this position. Coca Cola has been solid, not flashy, but very reliable as a dividend player. Moving on to LTC Properties, a healthcare rate. I own 100 shares at an average price of $34 and I'm up about 7% on this. It pays a dividend yield of 6.25% and I plan to keep building this position slowly, especially if we see any dips. All right, now let's talk about one of the underperformers in my dividend list, and that's Target. I currently have 26 shares at an average price of $109 and I'm currently down 12%. It does pay a dividend yield of 4.63%. I actually want to exit from this position and move this capital into SCHD, but let's see what happens. All right, now let's shift into ETFs, starting with SCHG, a solid growth focused ETF. I currently have 321 shares at an average cost of $24.88 and I'm up 22%. Whenever SCHG dips below the 200-day EMA on the daily chart, I continue to add more. Long term, I see this becoming one of the best total return machines in my portfolio. I'll skip SCHD and IBIT as I've covered in the starting of this video. Moving on to JEPQ, which is a dividend beast. It pays over 10% yield and distributes monthly income, making it a great addition to my passive income plan. I own 63 shares at an average cost of $53.68 and I plan to buy more if it drops to $51.50. Now let me talk about an experiment, AMDY, the Yield Max ETFs for AMD. I hold 200 shares at an average cost of $9.70 and I'm currently down 18%, but I've received around $650 in dividends. So overall, I'm still in the green. That said, I'm not a fan of this model. You're basically losing capital while earning taxable income, which doesn't make any sense in the long term. So I plan to exit this position and relocate into more reliable dividend names that actually hold their value. Let me know your thoughts on YieldMax ETFs or drop a comment below. I'd love to hear how they have worked for you. That wraps up my dividend and ETF positions, slow and steady but critical to long-term success. Together, they provide a strong base for passive income while I continue to take strategic risks with growth stocks and swing trades. Let me know which dividend stocks or ETFs you are building in your portfolio and what strategies you are using to reinvest or allocate that income. All right, let's talk about one of the swing trades that hasn't gone as planned, and that's Bill Holdings. I'm currently down over 8%, and the stock has been moving sideways for the last 6 months, just consolidating without any real direction. They reported good earnings this week, and the stock jumped from $40 to $49. I'll hold for a few more days to get break even and sell it off. This is just part of the game. Not every trade plays out perfectly, and it's important to stay disciplined when things don't go your way. So far, I'm genuinely happy with how the portfolio has shaped up in 2025. Strong gains, a steadily growing dividend stream, and most importantly, plenty of flexibility with my 50% cash position. As always, thanks for watching and being part of the mindful investing journey. If you got value from this video, make sure to like and subscribe. It really helps push the video to more people like you. And now, I'd love to hear from you. What changes would you make to this portfolio to boost performance for the rest of the year? Drop your thoughts in the comments below. Thanks for watching, and I'll see you in the next one.